Another whipsaw day on the market, as we've seen the Dow all over the place. Just look, it rallied 500 points, lost most of the gains, then started to climb again. And despite it all, the Nasdaq is still classed as a bear market, down more than 10%. The other major indices aren't far off. Not all stocks are getting hit equally. Some big names are much harder fallers than others. So JP Morgan, Visa and Boeing are all at their 52-week lows for individual reasons. Interest rates in some cases, but economics and Russia in others. And investors are fleeing Amazon and other stocks highly geared to US growth. The Fed rate hikes and the Russia attack put this in, and you see these tremendous losses in the market. Mark Zandi is with me, chief economist at Moody's. Mark, we've talked many times. I mean, when you and I last spoke, we were going on about inflation and interest rates. Neither of us could have realized that we'd be in such a perilous state economically now. But I need to know, inflation was a problem before. How much greater a problem now as oil goes through 130, possibly higher, and we end up with more supply chain issues? Where does inflation go?
Up, Richard. Nowhere else to go but up. I mean, just tie it right back to gasoline prices. I mean, before Russia invaded, you could get a gallon of regular unleaded nationwide at $3.50, maybe a little less than that. Last I looked, we're at $4.17 a gallon, and clearly at these oil prices, if we stay there, we're at $4.50. And I was listening to your previous guest, and some of his scenarios obviously can go a lot higher. And of course, gasoline goes into a lot of transportation, goes into food, goes into production of different commodities and goods. Right. So the inflationary effects are going to be significant.
In that case, I mean, at 6-7%, the Fed said they expected it would come down on its own, but the Fed's going to raise rates to bring it down. I'm guessing, I mean, if all of this crisis adds more to it, the Fed can't act faster because economies are so fragile anyway. They're in an impossible situation.
Yeah, no, I mean, what do you do with this? I mean, if you're the Fed, I mean, obviously the higher gasoline prices is a hit to the economy. It's not as bad a hit as in times past because the U.S. is very energy independent compared to where we were 10, 20, 30 years ago. But it's still a negative. So we get slower growth. And then you have this higher inflation. And of course, we're all worried about inflation expectations because if they start to rise, then you get into this very kind of negative wage price dynamic that would be, would be very difficult for us to digest. And so what does the Fed do with that? My guess is at this point, they kind of try to thread the needle and they don't change anything that they were going to do before the Russian invasion. So, 4, 5, 6 rate hikes this year, and maybe they'll start to wind down their balance sheet sometime mid-year. So, they take all these cross currents, but put it all together and they say, hey, I'm not going to change anything, at least not yet, until I see which ways the winds are really blowing.
What's the fear here besides just sort of raw inflation? Is it that consumers get skittish and decide to save and not spend? I mean, is there a scenario that you see that has either the US or the UK or the EU going into a recession as a result of Ukraine and Russia?
Sure. I mean, there's, some pretty dark scenarios. I mean, I think the thing that worries me the most is if inflation expectations really do begin to rise, because at that point, people say, hey, to their employer, you got to pay me more because I got to pay more for my gas to get to work and all the other costs of living. I have to pay for all my higher cost of living. The business person says, no, okay, no problem. Right. We can do that because they know and think I can raise prices on my customers. And you get into this kind of self-reinforcing cycle. And the Federal Reserve and other central banks just aren't going to tolerate that because they know in the long run, that's going to be even more painful to try to get rid of that dynamic. So they'll really step on the brakes, raise interest rates, and the economy will seize up at some point. And that's a recession scenario. That's kind of a classic kind of business cycle.
So the markets, I mean, I understand, of course, the markets are just about impossible to forecast on any given day. We're now down and on the Dow and up on the Nasdaq. But my point is that any individual stock, I can give you a reason why Ukraine, Russia is affecting it. But the market overall is repricing risk. And I guess no one knows how far down that risk is going to go.
That's absolutely the case. I will say though, and it's kind of a sanguine perspective on things. I mean, since Russia invaded Ukraine, or it became obvious that they were going to, the market's gone up, and as you pointed, it goes up, goes down, goes all around. Intraday, it's all over the map. But if you look at the price today, it's not that much different from where it was when Russia invaded. So the market is saying, investors are saying, "Hey, obviously this isn't great. I don't like this," but they're not saying or pricing in, a recession down the road. So as long as that continues, I think we'll be okay. That's a good indicator to watch to gauge just how things are going to play out here going forward.